All right, ladies and gents, thank you so much for joining me. I know it's a little bit early on a Saturday morning, but here we are. Rise and grind. The hustle does not stop. Right, today, we are going to be talking about expectations. So I'm hoping everybody knows what this is. If you're tuning in, this is Mind Over Markets. This is session number 3 of your bootcamp. And today we are talking all things expectations. So the last couple of sessions, we've worked through talking about the importance of our belief system. We've talked about the importance of accepting uncertainty. And yeah, as I mentioned, today we're talking about expectations. I truly believe that having the wrong expectations is what screws over most people going into trading, whether it's on a personal account, whether they're doing a funded challenge, whatever it may be. But the wrong expectations generally lead to the wrong outcomes. And that's essentially what we want to unpack today. Give you guys some greater context as to, I guess, what most people seem to do wrong and what you guys can start to do differently. Now, everything that we've covered up until now, I'm hoping has started to get you to think beneath the surface. And what I mean by that is where most traders tend to struggle is they are constantly focused on how are my emotions screwing me over? And the problem with that is it's a very reactive approach. The emotions that you experience generally are not the underlying cause. They're not the underlying reason behind what you're experiencing. And so when you're only ever reacting to something after the fact, you're always chasing your tail. And this is why most people struggle to fix their psychology, because they're not fixing the root problem. They're constantly just fixing the symptom of the problem. It's no different to constantly taking painkillers or paracetamol for a headache. If you never address what's causing the headache in the first place, the headache will eventually always come back. You're just managing the symptoms over the top. And that's where I'm hoping you guys have started to think a little bit differently. You're starting to think in the markets in terms of probabilities, and you're starting to understand that your mind is essentially always just trying to do one thing, and that is trying to resolve some kind of pain or fear or address some kind of threat or danger that it seems to be experiencing, right? Now, obviously, I'm not expecting that you guys are going to completely have transformed your mindset right from, I guess, session 3. But I'm hoping we've started to lay that foundation. I'm hoping you guys are starting to think about things a little bit differently. And you're starting to see where some of the maybe more common traps are that most people tend to fall into. Okay. I want to share my screen with you guys. And I'm going to take you through, I'm going to throw up a whiteboard. And again, just throw up a few notes on there, which I'll share with the copy of today's recording as well. Give me one sec. Okay, so I'm hoping everyone can see the can't talk this morning, whiteboard all good. As I mentioned, this is week 3. Today we are talking about expectations. And I want to start off by actually covering where most people go wrong, right? And I want to start this off, I guess, with maybe a little bit of a question. I think that's probably the most effective way to kick this off. I don't want to make these sessions very much a one-way source of information. I want to try and keep them as interactive as possible. I want you guys to be getting involved and thinking as we go. And so I want to start this off, I guess, by asking you a question. That question is, when you guys put on a trade, what do you expect to happen? Okay? When you guys put on a trade, what do you expect to happen? And again, I'd like to see some responses here inside the Zoom chat. Okay, so a few responses so far. To get profit, to go to take profit, and the market's moving to my bias. Okay. Does anyone on the call actually ever open a trade and expect a loss? Not a trick question. I'm not expecting everyone to say to go to profit. There are some people that actually open a trade and they're expecting to lose because that's what their belief system has framed for them. They're so used to losing that they are used to that process, and that's what they expect going forward. Generally speaking, I think more people fall into the category of what we've seen so far in the Zoom chat, which is most people are expecting the moment you execute a trade, the moment you hit buy or sell, most people are expecting that it moves to their take profit, right? Or moves in the direction that they are hoping. And of course, I think this is probably the most obvious way of thinking. And I say that because if you weren't expecting to win or weren't hoping to win in some way, shape, or form, why would you put on the trade? Why would you open a position? Most people logically, when you think about this, why would you open a position if you thought, you know what, there's a good chance here that I'm probably not going to make money? Because anytime you're inclined to think that way, anytime that the market is not doing something that you like, the chances are you're going to be spooked and you're probably not going to want to put on the position, right? So the first thing I want to highlight, whether you've responded, whether you're doing this exercise mentally, whatever it may be, the first thing I want to highlight is that most people, the vast majority of people that I tend to speak to, they never actually stop to think about what their expectations are before they click the buttons. And this is half the battle that most people face. Most people have not even addressed what is going on mentally before they get involved in the markets. And ultimately, this is what screws most people over. Because the moment you have an expectation of what the market should do, or I should maybe say an incorrect expectation of what the market could do, then you're starting to already introduce some kind of emotion into your position. Because most of you have responded in here. And again, we're only taking this of a handful of responses, but most of you have responded that the moment you get into a trade, you're expecting or wanting one thing to happen, which is you want your trade to move into profit, which immediately means the moment a position starts doing something that you haven't expected, you're going to be disappointed. You're going to be disappointed when the market has not fulfilled your expectation of what you think is going to happen. And this is, like I said, an inherent problem. You are already opening the door for emotions to be introduced into your trading, and we haven't even begun, right? We haven't even started the process of managing the position, thinking about exiting for profit or for loss, whatever it may be. You're already putting yourself in a position where emotions are ready to be introduced. And this is, I would say, the first thing that most people do wrong. They don't even address what is going on mentally and ask themselves, is this the right thing to be thinking before I get into a position? So this is going to be one of the underlying themes of today, right? And it's going to be making sure that you're addressing the expectations that you're bringing into the market before you hit buy or sell. Because when you don't do that, you're again putting yourself in a position where you're likely to be very reactive to a situation, and more reactive than you would be if you addressed the situation right from the very get-go. Demetrius says, my biggest problem is that I expect it to go straight to TP. If it doesn't, or any consolidation or pullback, it's destroying my emotions, right? Now, let's talk about this. I hate it when it does this. Give me one sec. Okay, cool. Let's unpack some of the psychology behind this, because I think this is going to be completely linked to exactly what Demetrius has mentioned here, which is one thing we've started to talk about over the last couple of weeks is the mind is essentially designed to do one thing. The mind is wired to protect, right? It's designed to protect you from pain. It's designed to protect you from danger. It's designed to protect you from any sort of threats. And this is why we feel fear. This is why we feel anxiety. So exactly what Demetrius has explained here is that when the mind doesn't do when the markets don't do what you are expecting internally, if it doesn't go straight to take profit, then what happens is the mind moves into essentially fight or flight mode. And it does what it does best, which is, I like to call it our pain avoidance mechanism, right? Our pain avoidance mechanism is designed to put us in a place where we are constantly thinking about avoiding pain rather than accepting and embracing it. And in many areas of life, this is a helpful mechanism, right? We shouldn't want to experience this sort of pain, danger, or threat in most situations in life. It makes sense to avoid those situations. Nobody's going to walk out in the street blindfolded. Nobody's going to want to drive a car with someone holding their hands over their eyes, right? We are wired instinctively to avoid common and obvious sources of pain. And the problem is when we carry this into the markets, we come in with the wrong expectations and then we start acting the wrong way, which leads us to screw up our performance. Okay. Now, a lot of this is driven by things like recency bias, right? Again, recency bias we introduced, I think it was back inside session 1. And from recency bias, what we tend to conclude is that most people come into the markets as positive thinkers. We come into the markets only expecting positive things to happen, and we never really expect right from the very get-go that things could go wrong. And when you don't expect that things could go wrong, it becomes very easy for things to eventually go wrong and for you to not be prepared or planned for essentially that situation. So our natural tendency in a lot of cases is we are putting our, I guess, the outcome of what we may feel based on hopes, wishes, and desires, mainly because our mind is wired to protect us, right? Most of us are filtering out or trying to filter out negative information, and we're only focusing on positive. Not everybody falls into this camp, but most people tend to fit into this position. And again, it is something psychologically that naturally starts to work against us. Now, again, I want to open this up for you guys to reflect on this. I'm a firm believer that expectations are the root of all emotions. Okay? Expectations are the root of all emotions. And I say this because if you had the right expectations, how could the market ever disappoint you? Right? Think about that for a second. If you had the right expectations before you went into any position, how could the market ever disappoint you? We've already established, just based on, and again, it's a small sample size, but I tend to see this as the common theme. We've already established that most people come into the market not really expecting every possible eventuality that the market could present. We've already expected that most people are hoping their trades run in line with their bias. They go straight to their take profit. They make money rather than lose money. Or in some cases, as Demetrius has said, that they expect it to go straight to take profit, right? They don't want it to see it consolidate. They don't want to see it to pull back. And all of those things are what end up screwing with our emotions. So if you went in with your expectations completely aligned with the markets, if you went in expecting that the market could either make me win money, lose money, or I could break even, and essentially those are the only 3 outcomes you could possibly get from any position. If you went in fully expecting or accepting any one of those outcomes, is it possible to feel disappointed? And again, I want to hear your thoughts about this in the chat. If you fully accepted the markets could either give you a profit, a loss, or a break even, could the markets ever actually disappoint you if your expectations were aligned? Thoughts in the chat, yes or no? Correct, right? This is, again, the perception that I see from most situations. Most people are coming in with completely the wrong expectations. And those expectations are generally the root of all of their problems. And what we want to address today is the natural pitfalls that most of us fall into. This is obviously what we're starting to address. And then what are the expectations that you should be having and how this can start to transform your approach to the markets. And again, a lot of this is very, very simple stuff, but it's stuff that's never really addressed from the very beginning. Because just being aware of the fact that most people come in with the wrong expectations is likely to make you better off in the sense that you're actually going to be consciously thinking about this process. The problem is most people are not conscious in this process. N&M Partners says, is this associated with the markets being uncertain so we can expect anything and that would be a good way to think? 100%. 100%, right? I've tried to build each of these sessions in a way that kind of builds on top of one another. And the idea of expectations coming right off the back of a session that we did on uncertainty is done by design, right? And again, this is something that we're going to address in a further point in today's session. Because I think that is going to be a reality of, I guess, what the markets can essentially do. And as you've highlighted, anything can happen at any time. And this is one thing that I want everyone to be aligned with. Okay. Demetrius says, isn't this contradicting the idea of having a bias? Not necessarily, Demetrius, right? Because again, I want you to think about this idea of having a bias and why it's important to a trader. Having a bias is important so that you know which direction to trade in. I agree with that. But having the correct bias does not determine whether you are successful or not. Saying that I need the correct bias in order to be successful means that you are predicating your success based on being one of two things, right or wrong. What I want you to start thinking about, I want you to drop this idea that you need to have the correct bias all of the time. And I want you to start thinking about your idea of success more like a risk manager, right? A risk manager does not care about whether their bias is correct. A bias is just one of several factors that has to line up in order for them to essentially take a position in the market. A risk manager does not care about what happens next at least in the next given trade, because they are prepared for any outcome that the market is going to present. And essentially, they understand that this game of trading is not about right versus wrong. It's about how much do you make when you're right versus how much do you lose when you're wrong. I think Myers has summed it up perfectly here, right? Bias means a higher probability and not 100% guaranteed. 100% agree with that, okay? So let's jump back to the notes real quick, right? Expectations are the root of all emotions, and we've established that everyone kind of agrees with this sentiment that if you had the right expectations, the market could never really disappoint you. And so this is something that we want to address from the very beginning. What else do most people do wrong when it comes to their expectations? Well, they have this flawed perception of overnight success. They have a flawed perception of overnight success. And what I mean by that is I think most people come into trading expecting that they're going to find success quickly and that they think a lot of people are actually making money. Now, I think this is a very, very flawed expectation. And I think a lot of people will say, you know, I think most people are losing money. I think 90% of people aren't really making it, because these are all things that they've heard online. I don't want to bring my opinions and biases into this chat. That's not my intention. I'm not trying to impart any sort of my opinions on you. I want to show you some real statistics, because I think a lot of people struggle because their vision of what success should be is predicated on what they see on social media. And 99% of what you see on social media is all bollocks, essentially. And so I want to show you some real statistics. I want to show you what you should be focusing on, because I think this is going to give you a much better idea of what the market actually represents. And I purposefully haven't written these up as notes so far because I want to show you the reality from some things which are unbiased. Okay. So I'm hoping everyone can see my screen. Let me minimize this. I've switched over to a website. And this website is IG. Some of you are going to be familiar with them, at least across the UK and Europe, I believe. They're probably one of the biggest and most well-known brokers for trading personal capital in the space. You will know, or at least you're going to come to know, that most UK and European regulated brokers are governed by a financial authority called ESMA, ESMA. They came into power in 2017 or 18, or sorry, they introduced some legislation around that point. And that meant that every broker that is regulated in this jurisdiction, UK and Europe, they have to disclose legally how many or what percentage of their clients are actually making money. And the reason I've pulled this up on a live website, and I can refresh this so you can see it, so that you know I'm not bullshitting you. I'm not feeding you some idea, trying to sell you some narrative. I want to show you the reality of trading, right? And if you look right up here at the top of their website, I'm hoping you guys can see this. 69% of retail investor accounts lose money when trading spread bets and CFDs with this provider. So again, this is not a biased opinion. This is not me telling you that most people lose money, and this is not me saying that most people make money. This is giving you just the raw reality of what the industry is like. One of the biggest European, UK regulated brokers that a lot of people do business with. I have a personal account with these guys. 69% of retail investor accounts lose money when trading spread bets and CFDs with this provider. This is one broker, okay? Let's check out another one. Again, another very popular one in UK and Europe. And again, I'll refresh the website and you can see here, 68% of retail investor accounts lose money when spread betting and trading CFDs with this provider. Let's go with another one. Again, refreshed from today. This is Oanda. These are the people that I actually opened my first retail account with in 2012. 76% of retail investor accounts lose money when trading CFDs with this provider, right? So these are all personal accounts. These are people trading their own money or attempting to trade their own money for a living. And you could see between 70 to 75% of people are failing to make a profit. Now, what these stats don't tell you is the remaining 25 to 30% of people that are not falling into this category of losing money. How many of them are actually breaking even? And how many of them are actually making a substantial enough income to actually support themselves on a day-to-day? How many of them are actually full-time traders? That we don't know. I suspect the stats are even smaller, okay? We've covered personal accounts. Let's have a look at the prop space. Now, there used to be a lot of statistics talked about this very, very openly, and they're not shared too much anymore, but I bookmarked a couple of these from a little while ago. You can see this is from January of this year, so about 10 months old now. These were from Funded Engineer, and these stats were taken from the Prop Journalist. You can see here that based on the account size, how many people were passing. So Demetrius was talking about this right at the very beginning with one of their friends passing their first account, and he was on the way to blowing one of his most recent accounts, right? So you can see based across the board, the average pass rate of a prop firm is about 12.57%. This statistics, I say, roughly remains unchanged. I think if you think around the 10% mark across all prop firms, this is probably about right. 10% of all people are actually passing their prop firm challenge. Now, I would actually say this is the meaningless metric. And this is what I wanted to address with Demetrius a little bit earlier. The pass rate of actually getting through a phase 1 or phase 2 is a BS statistic to actually focus on. I would say the more important one is actually this one here. The percentage of traders that are actually getting a payout. Because you have to remember, when we start thinking about this idea of expectations of what success is, I want you guys to remember that success is not about passing a challenge. Success is about getting paid. This is what we're here to do. And when you talk about the statistics of actually being paid, only 3% of traders who take a challenge actually get a payout. 3% of traders who take a challenge actually get a payout, which I think is a pretty crazy statistic, right? Means 97, 98% of people roughly are not making money, right? Not getting to the point where they're actually getting paid out. Last statistic I want to share with you. Again, this is from the Funded Trader, rest in peace. We all know pretty much how their story went. The Funded Trader posted this in, again, January of this year. And I thought this was a pretty crazy statistic, so I kept this noted down. In the last 60 days, here are some interesting stats. Traders that have failed 3 or more challenges, 11,957. Traders who failed 6 or more challenges, 3,468. Traders who failed 9 or more challenges, 1,462. Traders who failed 12 challenges in 60 days, 775. I put this one up on there because I want you guys to start to be aware of what the general consensus or thought pattern is of the industry. Do these statistics represent a group of aspiring people that are trying to take this industry seriously, right? 12 challenges in the space of 2 months. There are 700 people that failed, right? Ripping through and going challenge through challenge through challenge. Do these statistics represent people that are taking this industry seriously? I would say largely probably not. Okay. What I want to do here is get some of these noted on our whiteboard. So just so you guys, and again, I take these from websites, I take these from real tweets so that you guys know I'm not feeding you these stories or narratives which are based on my opinions. So we've established already that 25 to 30% of people trading their own money fail. And we've already established that 97% of people trading prop firms fail to make their first payout. Okay? Again, not based on my opinions, based on real statistics from unbiased perspectives. Okay? So we've already established a lot of people are coming into trading with a vision of overnight success, because if that was not true, I suspect those stats would be different. Okay. Where else do people go wrong when it comes to having the wrong expectations coming into trading? Well, one thing that I think a lot of people do is they don't expect things like drawdown. This is something that most people are actively trying to avoid. And what I reiterate to most people is that it happens to every strategy with an edge. And the problem is most people don't expect drawdown. When you're not fully expecting that drawdown is possible, it's not going to happen, then you're putting yourself in a position where essentially you're stacking the odds of probability against you, right? Mark Douglas said it best. I'm probably going to butcher the comment, thinking of this off the top of my head. I don't have this down in my notes, but he always says, or he's written in Market Wizards. Why am I thinking of this wrong? What the fuck is how am I'm just completely gone blank this morning. There we go. Myers is switched on today. Clearly my brain is not working. Trading in the Zone, the fucking Bible of trading psychology, which basically should be my bedside given my job. Trading in the Zone, Mark Douglas says there is a random distribution between wins and losses for any given set of variables that go on to define an edge. So that means losing streaks can happen, and that means winning streaks can happen. And this is something that I want you guys to keep in mind. I want you to remember that drawdown is a normal part of any given strategy. And if this is not something that you are expecting, if you're not expecting that you are going to take a loss at some point in time, you are coming in with a flawed expectation, right? Experiencing a loss in your trading is basically the cost of doing business. It's no different to paying an electricity bill to run your brick and mortar store. It's no different to paying for a domain to have a website that runs online, right? It is a normal part of actually doing business in the markets. Thank you, Mize. Saved me there for a second. Completely went blank. Couple other points I want to mention. Account size. This is specifically for those of you that are going down the prop firm route. And again, we're going to talk about this a little bit today. a lot of people have the wrong expectation when it comes to account size because they are picking an account they are not ready for. What I mean by that is prop firms have given us this amazing ability to be able to basically leverage a few $100s to get funded with a few $100,000. And for most people, they are not mentally prepared to be able to handle that level of money. And this is why prop firms have a big edge in the market. They tell you if you invest $500, $1,000, you could be funded with a couple $100,000 going forward. And whilst there is some truth to that, psychologically, most people are not in a position where they are prepared for that outcome. So what I say to most people is you have to be ready for the amount of money that you are willing to basically take on your challenge. The problem is most people buy their challenges based on how much money they want to make and not necessarily how much money they are comfortable in risking. And so I want you guys to remember, regardless of what account size you buy, regardless of if you think in percentages, there is a dollar attached to every amount of every trade that you take essentially in the markets. And so what I say to most people is if you're not comfortable with the dollar at risk, the actual dollar amount, you will struggle because your mind always knows how much money is behind the percentage of what you're risking. 1% of a $6,000 account and 1% of a $100,000 account, yes, it's the same percentage, but your mind understands the difference between those risk parameters, right? Most people go in and I like to apply these sort of analogies to the gym because I think they work really, really well. And I think they're very easy to understand when you apply it this way. I have a feeling I might have given this analogy on a Q&A session in one of our previous ones already. Most people would go to the gym. If you had a goal of bench pressing 100 kg, most people would go from 20 to 30, 30 to 35, 35 to 40, 40 to 50. You would scale up slowly, right? You would slowly increase the exposure of how much weight you're lifting over time. But when it comes to managing money, we try and do this completely differently, right? We understand if we try to bench press 50 kg today and then go up straight up to 100 tomorrow, your body would crumble because it's not ready for that level of weight yet. But most people don't apply this same thinking to managing money, right? Most people go from, I can manage a $1,000 account fine, I can manage a $10,000 account fine, and they instantly think, bang, I'm ready for 100,000. I'm ready for 200,000. I'm ready for 50K. It doesn't work that way, right? For most of us, you're better off thinking about this the same way you would in the gym, which is my mind has to be slowly exposed to higher amounts of money over time. And again, this is a flawed expectation that most people have coming into the markets right from the very get-go. They pick their account size based on how much they want to make and not necessarily how much they are comfortable in risking. Okay. Last thing I want to mention here, I want to put this under recency bias, which we covered already. I want to talk about most people going from phase 1 to phase 2 and how it gives them inflated expectations, right? When most people pass a phase of their prop firm challenge, and I think N&M Partners had put, I got funded 5 times and only paid out once when we were talking about the statistics of this. One of the things that tends to work against most people is they bring their success from phase 1 into phase 2, or they bring their success from phase 1 and phase 2 into their funded challenge, and they believe that they've already won the game when in reality, the game hasn't even started yet, right? I want you guys to remember right from the very beginning, the goal is to get paid. It's not about passing challenges. Just because you get a fancy certificate at the end that says you are now a qualified and funded trader and you've made it through phase 1 and phase 2, the real reality is it means fuck all until you get paid, okay? And I like to keep it as real as that. I like to keep everyone on board with the idea that the goal is always to get paid from the markets, okay? Does this make sense to everyone? Do these common pitfalls of flawed expectations make sense to absolutely everyone on today's call? Again, just yes or no in the chat. I just want to make sure everyone is on the right wavelength so far. Perfect. Okay, so we've addressed what most people do wrong with their expectations. These are some of the very, very common pitfalls that most people are falling into. What can we start to do differently, right? The juicy stuff. What can we actually start to do differently? Coming off of what we discussed last week, right, which is this idea of the markets are uncertain and essentially anything can happen at any given point in time, I want you guys to understand that when I say anything can happen, I mean anything can happen. There was a particular day that basically has been imprinted in my mind and has stuck with me forever. And I want to show you exactly what that day looks like. Give me one sec. The smallest fucking chart I have ever seen in my life. All right, let's blow this up a little bit. Sorry, I'm working off one screen today. This is going to be very, very messy. I'm hoping everybody can see this. I'm hoping this is somewhat clear. I'm going to try and blow this up a little bit. This chart is the US dollar versus the Swiss franc, right? Dollar Swiss. Some of you may be familiar with this chart. Some of you may have traded this at some point in time. I have backtracked this, and I believe this day, I don't have TradingView up, but I've screenshot this to throw into our presentation today. This chart is from January the 15th, and I'm talking about this big fucking dildo of a candle that basically stands right in the middle of our chart. This chart is January the 15th, I believe, 2015. And this was the day that the peg was removed between the Swiss franc and the euro, I believe it was, right? This was the day the peg was removed between the Swiss franc and the euro. Now, to put it into context, most of you will be, I'm presuming, familiar with TradingView. You'll understand this is a daily chart, so you'll understand how big of a move that actually represents. This particular market moved around 2,000 pips in the space of, a few minutes. Again, this is represented on a daily chart. I watched this day play out live. Thankfully, I was trading personal capital. I didn't have a lot of money involved in the markets at that time, probably a few hundred, maybe a few thousand at that point. It was pretty early on into my career. As I mentioned, I started in 2012. I watched this move happen live, and it changed my perspective on what the market can do at any point in time. When you see things like this happen, not only did I see people lose essentially small fortunes that day, I saw brokers go out of business. And for those of you that don't believe me, there was a very, very popular broker around at that point in time called Alpari. Some of you may have heard of them, may not have heard of them. They were pretty big. They used to sponsor football teams and all sorts back then. Alpari. Give them a Google after today's session. Have a read of the story behind this. But essentially, the day this unexpectedly got announced by the Swiss National Bank, they went out of business because so many of their clients took losses that they were not able to cover. And they weren't the only ones. There were a bunch of, obviously, retail traders, banks, hedge funds, shitloads of people lost money on that day. And I like to include this as part of my presentations to help you to understand the idea that when you see days like this actually play out, I want you guys to remember that anything can happen at any time, right? Anything can happen at any time. And it takes essentially one day to lose it all. And the problem is most people do not expect it. The idea, as Myers is saying, a black swan event that stands out to me is when crude oil went negative in 2020. 100%. 100%, right? The thing is, these black swan events, nobody can ever predict them ahead of time. Hence, they're labeled black swan events. And essentially, all it takes is one to really screw you over. And when I talk about screwing you over, I think most people are, I guess, in a position where their perception of risk is somewhat tainted because most people are only trading prop firms. When you're only trading prop and you don't have your personal capital on the line, you don't give too much of a shit about a day like this, because you take a day like this, guaranteed you're getting slipped a stupid amount of money, and you're probably going to blow your account, right? You get a black swan event like this, you're probably going to blow your account, whether you're in a challenge, whether you're funded, whatever it may be. When you get real events like this, chances are account's going to get blown. And for most people now, you're fortunate enough to be able to take another few $100s and start your challenge account all over again. If you're in a position where you have an aspiration to trade personal capital, investor capital, these are situations which will ruin you in one day. I have seen people that have traded, and they've shown this on my FX book and things like this. And again, I know a lot of people say these are not too credible now, but I've seen people that have had amazing track records. And this has gone on for 3 months, 6 months, a year, 18 months, where they've made consistent profits. And it's taken one day, whether it's either a black swan or they just gone on tilt, and essentially they fucked it. In one day, their entire account went to absolute zero. And so I use this as a demonstration. And I like the fact that obviously people like Myers have lived through experiences where they've seen these events happen, and it very much humbles you. It gives you a perception around respecting risk and respecting the markets in a way that will stick with you over time. And I personally think it is having this idea that anything can happen at any time is something that will really serve you well in the markets. Because most people, and this is why when I look at the state of social media these days and I see people bragging about profits or bragging about analysis or living this trader lifestyle, I genuinely see it as a sign of inexperience. When you've had enough experience in the markets and you see and live through and survive some of these black swan events, it humbles you. You do not get more cocky after experiencing these. It makes you more humble. And so when I see people flaunting the trader lifestyle and showing this idea that it's just fancy watches and cars and holidays and all this bullshit, it is not a true reflection of what trading is like. The best and most successful traders that you will ever meet are humble because they understand exactly what the markets can do. And that is, anything can happen at any given point in time. And so when we talk about what to expect in the markets, I want you guys to open your mind to the idea that anything can happen at any time. And I'm hoping this one example can give you some perspective of exactly what that could potentially look like. Maya says, you learn to manage your own risk or else the markets will manage it for you. 100% agreed, right? 100% agreed. So how else can we look at this? Right, give me one sec. Sorry, I'm not sure if you can hear the dog barking in the background. I don't have my good home setup as usual, so it means I have a bit of a shitty laptop mic that I'm working with today. When we talk about what expectation you should have for the market, I want everybody going forward to expect that there are 3 outcomes to any trade. And this is not just, this is addressing what we started with right at the very beginning of today. Everyone goes into the markets and they expect their trader going to go to take profit. And obviously there has to be some assumption of that. Otherwise you wouldn't put on a trade. If you thought with 100% probability, this trade is going to lose me money, nobody would ever fucking put on a position, right? So I want you to be realistic about your expectations. And I want you to think of it in the case of there could only ever be 3 possible outcomes. You can either have a big win, you could have, sorry, not that, a small win, or a small loss. These are the only 3 outcomes that I want you guys to be expecting. If you can eliminate the idea of ever taking a big loss, you are going to put yourself in a position where you have a good chance of succeeding in the long run, right? The only 3 outcomes that I want you to mentally prepare yourself for before you get into the markets is this position is either going to be a big win a small win, or a small loss. And I account break even as part of this. If you're breaking even, you're essentially taking either a very small win or a very small loss, depending on the commissions and maybe swap fees, whatever it is. Essentially, these are the only three outcomes you could ever expect. And again, my question to you guys is something for you guys to reflect on and think about. If you went into every position expecting that the market was only ever going to be a big win, a small win, or a small loss, how could you ever be disappointed by the markets? How could the markets ever disappoint you in whatever it produces? And the reality is the only way you could be disappointed if you went in believing this is if you experienced a big loss, which was unexpected, because obviously anything can happen at any time. And in which case, it would probably be okay to feel some kind of emotion at that point, right? If you went in with these correct expectations right from the very beginning, you are putting yourselves in a position where you are more likely to succeed in the long run because your expectations are now truly aligned with the markets, okay? What else should you be expecting right from the very get-go? Well, when it comes to getting funded versus getting paid, I always like to remind people of what your job is as a trader. What is the goal? And again, I'm hoping we've made this clear from the very beginning. The goal is always to get paid. The goal is not about getting funded. The goal is not about getting your nice little certificate that you can hang up on your wall to say, congratulations, you made it through phase 1 and phase 2, right? I want you to remember that prop firms are in the business of making money. And that means they play with human psychology, right? Prop firms play on human psychology in order to make their money. And they do this, put this under a different section. They do this by showing you leaderboards. They do this by giving you certificates. They do this by hosting competitions. And again, I'm not saying these are all negative things, but in the vast majority of situations, I want you to remember that leaderboards, certificates, and monthly competitions are only there to fuck with your psychology. And again, I'm saying this from the perspective of I talk to hundreds of prop firm traders every single month, and I see so many of them constantly falling victim to this sort of these traps. So I want you to remember, if you're going down the route of using prop firms, and again, I encourage them, be mindful that you need to be ignoring leaderboards, the certificates, either your own or the ones that you're seeing of other people, and not really taking the competitions too seriously if that's something that you're getting involved in, right? They are mostly designed to mess with your psychology. And when we're talking about creating the right expectations, your expectations should not be based off of these things. Leaderboards, it's irrelevant. Your job is to focus on your process and not anybody else's, whether it's somebody that you know, whether it's somebody that you've seen on social media, whether it's your best friend. It does not matter what they are doing. It does not influence your ability to succeed in the market. It doesn't matter about the certificates that you get, right? Unless it's the payout ones, right? Which is then you completing your job. Getting funded is not the point of what we're doing here. The monthly competitions, again, they're done with an attractive basis to win challenge accounts, money at the end of it. I know quite a few prop firms host these now. But again, by and large, they're there to essentially screw with psychology. I want to give you guys one tip to take away to help you to become a little bit more aligned in terms of your expectations. We mentioned this a little bit earlier, but most people come into the markets expecting that it's going to be right versus wrong, right? I can't remember who it was. Somebody mentioned in the chat earlier, what's the point of having a bias? I want you guys to start framing your mindsets a little bit differently. This is not about right versus wrong. This is about how much do I make when I'm right versus how much can I lose if I'm wrong. When you start thinking of the markets in this way, as opposed to am I, right in this position or wrong in this position? When you start thinking of it like this, then you start thinking like a risk manager rather than the amateur trader, which is essentially just trying to be right in their analysis. There's a great psychological tip that I want to share with you guys. That I think would be really beneficial that you can tweak to your journal, right? When most people journal and they record the outcomes of their trades, one thing that they like doing is they record winners as, winners and losses as losses, right? They think in terms of black and white. They think in terms of right versus wrong. The problem is when you're thinking in terms of right versus wrong, you're connecting with the wrong belief system. You're connecting with the belief system that says, or you're connecting with a belief system which has been given to you in every other area of life. What I mean by that is in most other areas, and we talked about this in session 1 when we talked about beliefs, in most areas of life, we're taught that in order to be successful, we must be right, right? I can't get into a good job or university if I don't have the right grades. I can't be rewarded for things at home if I haven't been, a good child, sibling, whatever it may be. We're taught right versus wrong. When you start thinking about winning and losing, it psychologically, it connects with the wrong belief system, because then you think, if I don't make money, I haven't done the right thing. And what I want you guys to start thinking about, if I said to you guys, revenue and expenses, what's the first thing that you think of when I mention the words revenue and expense? Hoping someone's going to get this in the chat. Bingo, right? Demetrius says business. When you talk about the idea of thinking about trading like a business, one of the best things you could do is start to think about winners as revenue. And I specifically say revenue and not profit, because your profit is revenue minus costs, right? It's revenue minus your expenses. I want you guys to start labeling your trade outcomes as revenue and expenses. Because when you start doing that, you start thinking of it not in terms of the belief system that I've been brought up with. You'll start thinking about it in terms of a business mind. Revenue and expenses is a type of terminology that connects with a different belief system. And so it's a very, very easy psychological hack that you can start to impose into your trading by simply changing the wording and terminology at which you are thinking about the positions that you are taking. So this is no longer winning versus losing. This is no longer a winning trade and a losing trade. This is revenue, and these are my expenses. When you start thinking about it like a business, then trading becomes easier to treat like a business, okay? Everything starts in the mind. And so I want you guys to take this hack away and start to tweak your journals to reflect this. If you're using a journal which doesn't allow you to actually label them that way, if you're using something fixed and online, for example, at least start mentally thinking about them this way, right? Revenue and expenses as opposed to winners versus losers, okay? Hoping that makes sense to everyone. And you guys can see the benefit in starting to think this way. Okay. Is everyone on board with what we've covered today? Is this making sense to everyone? Everyone's understanding the pitfalls that we fall into, and you're coming away from this session with at least some clarity on what you can start to do differently in terms of your psychology, right? How you can start thinking differently about the markets. Sorry, one sec. I'm just tidying up these notes. Like I said, I'm going to give you guys a copy of these off the back of this session. It will be uploaded into the Google Drive for you guys. Okay, so last thing I want you guys to do, very, very simple exercise today, Demetrius. As I mentioned, the mind is essentially a very powerful tool that would answer any question that you pose it. So if you want to start getting better answers or more effective thinking, we should say, off the back of this, I want you guys to start thinking and asking more powerful questions, right? So we're going to start this by doing a more reflective exercise from the very beginning, right? So the first thing I want you to do is I want you to reflect over your recent performance, and I want you to go back to the last time you were on tilt, right? The last time you started making decisions based on emotions rather than actually your process, your logic, right? I want you to go back over that based on your journals. And I want you to look over the last time you were on tilt. And I want you to ask yourself an important question. What made you angry? And would that be different if your expectations were different, right? Go back over the last time that you were on tilt, and I want you to ask yourself, what made you angry in that situation? And would that be different if your expectations going into that trade were different? Remember, if you fully expected that the markets were either going to give you a big win, a small win, or a small loss, would that have made a difference in how you dealt with that situation, right? And then again, very simply, going forward, I want you to ask yourself a very, very simple question going forward. What am I expecting? A question that I want you to ask yourself before you click buy or sell in any position going forward. What am I expecting? And again, of course, based on what we touched on before, revenue versus expenses. Start adjusting your mindset to thinking about wins and losses in terms of revenue versus expenses. Okay. Very, very simple exercises today. One reflective, one going forward. But I'm hoping this is going to make you much more conscious about this process and put you in a position where you can start to think about the markets very, very consciously going forward and how you can start to adapt these going forward. Okay. Okay, I think that pretty much wraps up today's session. So again, I will give you guys a copy of this. Will be in the Google Drive alongside the notes for today. Before we wrap up today, any questions that you guys want to run past me? Anything that I haven't explained well enough today? Is anybody confused by anything that we've covered? Everything was nice and clear. I just want to make sure everyone's on the right page before I leave you guys. Demetrius says, can I open the mic? Feel free, my friend.
Yeah, it's easy for me this way.
Go for it, bro. Go for it.
So I'm training since July of 2023.
Okay.
And I'm at a point where I can make, my biggest win rate, let me see, I'm not a native English speaker, so
no problem.
bear with me. The most I've reached on a funded challenge is 6%, almost 7%. What happens, and most of the time I think I went through 5 challenges, all of them 10K accounts, because I don't mind the $60, $100 pay on the initial fee. Okay. So my psychology is not affected by losing the account. Okay. My main, what happens after 5%? I think on all of them, I managed to get to 5%. What happens at that point? I mean, that 8%, is there a logic behind the 8% on the prop firm challenge to play with my psychology or everyone's psychology?
In the large part, I don't think so. I haven't seen a magical number that suddenly screws with everyone. It's really going to depend on the person. And so the only thing I would say is if you are getting to a point where you get past, like you said, 5-6% maybe, and suddenly something starts to screw up mentally, the best way for us to unpack that is to understand what is changing in terms of your thought process. So if you have this already to hand, if you don't, then this is something that I want you to start journaling. When you're getting to those stages where you get past the 5%, I want to understand what is changing in terms of your thought process. What I probably think is you're either getting overconfident in your approach, or you're starting to feel like you're approaching the finish line when actually in reality, you have to remember the finish line is nothing to do with phase one. It's nothing to do with phase two. It is everything to do with getting paid. And that is a long, long journey ahead. Does that make sense?
Yeah.
So I want you to really start to understand this from a psychology perspective. I don't want to sit here and try and give you some generic advice. The best thing we could possibly do is to come back in a future session or to dig these out from maybe journals that maybe you already have and throw them in the Discord for me, and I'm happy to work through them. Is I want to understand what is changing mentally, because you're either there's one of two things that's happening here. Either you're getting very, very unlucky over the last 5 challenges you've taken, and after you've hit that 5%, the market conditions haven't aligned and you've blown your account as a natural form of like drawdown. And maybe there's something we can improve on there in terms of your risk management. But I think more likely, if it's happened 5 times and it seems to always happen past that point, something is changing mentally. You're starting to think in a way which is, I've already won the game, or I'm getting so close and I'm feeling excited, or I'm feeling overconfident because I've done so well so far, and this is screwing up my process. The best thing you could do, Demetrius, 2 things that you could take from this. First one is check over the journals. Like I said, if you're not already keeping a journal of what's going on mentally when you're making these decisions, start doing that today. And that's something that we can start to address and we can work through over the coming weeks. The second thing off the back of this, and again, I don't know if this is something that you already apply, I'm a big fan of using a pre-trade checklist, right? That checklist is basically just a list of criteria that tells you this is what needs to happen before I can take any action in the markets. So this must say, in order for me to execute a position, this must happen, this must happen, this must happen. I must see a fair value gap. I must see market structure shift. I must see whatever it is. It doesn't matter what your rules are, but you have to have these written down. Before you take any trade, you must be able to tick off every box. Because the reality is, if you're breaking your plan, you're not going to be able to tick one of those boxes off. And this process is going to make you more aware that you're about to do something outside of your plan. Does that make sense?
Yeah, totally. But I don't know if you are familiar with David's strategy. He's really, I don't know, he's fluent with his entries, with his, I don't know if he, most of the time, if one thing happens and he already had the bias to support that one thing, he already got in. I don't even know how he got in, but the checklist doesn't support like that style of, because I also want to get where he is. Yeah, he's
let me tell you something, Demetrius, right? This boot camp is, I got a lot of respect for David, right? I'm not super familiar with his strategy. So I can speak to him and we could talk about this idea of how he's fluid to get into the markets. The one thing I will tell you from a psychology perspective, your goal is not to be like David. Your goal is to be the best version of Demetrius. The more and more you start focusing on trying to be like somebody else instead of the best version of you, and that goes for comparing yourself to David, that goes for comparing yourself to your friend that passed phase, whatever it was, and you are not at that stage yet, you are moving further and further away from the point of what is the best thing for me. I understand David may have a fantastic and phenomenal approach to the markets, but if that approach is not working best for you, at least at this point in time, obviously it's something that, yes, we can work towards, but you need to find something that actually is giving you the results that you are looking for. The goal here is not to be a clone of David in terms of his strategy and analysis. And the goal is not to be a clone of me in terms of the psychology and thinking. The goal is to get you to start thinking. It's to give you a structure and a framework that is going to work the absolute best for you. The way that you win as a trader is to find the magical formula that works best for you. I can have people approach me that think completely different to me, that trade completely different to David, but they could be rightly successful in their own way. And that's the goal, right? You only find consistency when you find how things work for you. And the more you are focused on trying to be like others or keeping up with the pace of others, I promise you, the further that you will move away from the goal. Does that make sense?
Yeah, man. Yeah, this is one of my biggest. I'm really tough on me, and I really want to be like the top 1% in this field.
And the one thing I can tell you, I've been very fortunate to meet a lot of successful, I say a lot of, I've been fortunate enough to meet a fair few profitable traders. Every single one of them is different in their approach. Every single one of them has a background, a thought process that leads them to find the answers they're looking for, but in a very, very different way. And I can promise you this, everything starts from understanding that this is a game of psychology. I'm not saying the strategy is not important. It's super important, but you have to understand from a psychological perspective, everything starts from the perspective of you have to realize that this is a one-player game. This is you versus you every single day. The more you are focused on other people, the less you are focused on your own path. And this is where I love this idea of winners focus on winning, losers focus on winners. You're here part of this boot camp, not to become clones of us, but because we want you to start thinking differently and to give you that framework to find your own path of success, right? Everything that we're teaching here is about you thinking differently, you learning a strategy that works, but then importantly, going away and doing the work yourself to find the answers that you're looking for. Does that make sense? Does that resonate?
Yeah, totally.
Yeah.
One last question
Sure,
regarding
man.
this topic. Would you say that makes sense to? I mean, I was thinking maybe even stop joining the David's Discord, because I enter on Discord, I see something else, I start comparing, and I don't know. Then I don't execute on my plan because I see
Okay,
someone else.
gotcha. Are you familiar with this strategy enough so that you understand it for yourself and
Yeah,
you've back tested it already?
yeah,
So then my advice would be to at least stop tuning in on a day-to-day basis, right? I think the best way to find a balance between being inside of a trading community, and I say this from the perspective of I work inside a variety of communities and I experience this same battle. It's how do you not get consumed with what other people are doing and just focusing on your own shit? And a lot of the way that I think the best way to do that is to filter when you start checking the Discord. So that maybe that's going to be at the end of the day. Maybe that's going to be just tuning in at the end of the week and reflecting on what other people did. You want this to be a place of, yes, you can grow, you can connect with like-minded people, you can have these conversations and connections, but you don't want it to be a place of distraction. So if you feel like it is at the moment, then I would say you don't need to leave entirely, but just evaluate when and how you're spending your time engaging inside the Discord. Okay.
yeah. I'll start doing this. Yeah. Thanks,
Perfect.
man.
All right, man. Pleasure. Couple other questions we had in the chat. Haraj says, shit, I'm late. When will the stream be uploaded approximately? Haraj, for you, never. Yeah, fucking, if you can't make it to a 9 a.m. lecture, nah, I'm playing. I will soon, as soon as it's finished processing on Zoom, I'm gonna try and get it up a little bit later today. So I'd say at the latest, probably by the end of the day. But I will get back to you guys. NNM Partners says, I'm improving a lot with these classes, but when I get in front of the screen, it's like I forget everything. I get carried away by all the bad psychological things. In the next classes, we will talk about what to do before, during, and after trading, like, for example, a routine or review of classes or any ideas. So as we get towards, I think, session 5, we're going to be talking about discipline. Part of discipline, we're going to be talking about routines, habits, and ways that you could be a little bit more focused when you're on the chart. So that'll probably be session 5, so a couple of weeks from now. But otherwise, what I'll do is I will start throwing out some, like I said, I'm throwing out weekly challenges inside the Discord now. I will start throwing out a challenge which is more based around keeping you guys focused on the day-to-day and week-to-week. But NNM, same advice to you. Again, I encourage this to everyone. Implement the pre-trade checklist, right? If you have certain things that you want to remember, have them noted down in front of you. It doesn't just have to be criteria of getting in and out of a trade. It could be little nuggets or quotes or things that are going to remind you of what you need to be thinking about mentally getting into the chart. It could be something simple of, you could just have written down in front of you, big win, small loss. 3 expectations getting into a trade. When you think about them the right way, very, very beneficial. And again, just triggers your mind to start thinking in the right way. So I'll start throwing those into the examples, but again, we will cover that as we go. Mehul says, sometimes I don't take trades for a week or two, so I feel like I can't do it. I'm not good enough. All these negative thoughts kicking inside. How to control these? Mehul, the problem is you're trying to control your thoughts. The problem is the solution is not controlling them, it's regulating them. So the way in which we're going to be starting to do that, and again, we're going to be covering this over the coming weeks as well, is this idea that your goal is not to change or to control your mind. In session 6, week 6, we're talking specifically about emotions and how you deal with them. And what I want you to do is start to remember that your goal is not to change the emotions. Your goal is to recognize when they are happening. And I'm going to encourage that through either meditation or journaling throughout your trading day. When you recognize the negative thoughts and the emotions, then we're going to start working on how do you reframe those? How do you start kicking those thoughts and reframing them into something more positive, which is going to be more beneficial for you going forwards? So the advice that I would give you today is stop trying to fight your mind. Start accepting that your mind is just trying to protect you from pain. If you are feeling like you're struggling to take a trade for a particular reason, I want you to start better understanding, are you feeling hesitant to take the trade because you're afraid of losing the money? Or are you feeling hesitant to take the trade because you're afraid of being wrong? These are 2 very different things when it comes to establishing why you're hesitating after a couple of weeks of being inactive. And understanding which fear you're being controlled by is going to be very, very helpful. So again, something to reflect back on. You can either give me a response on our next session or feel free to throw it inside the Discord. NNM Partner says, I have 2 screens, for example, to put phrases and keywords on the second screen. Would it be a good idea? For sure. Look, there's no limitation or right or wrong way to do this. It's just finding a way that works for you. I know some people that have put them on the background of their phone. So every time they check their phone, they're seeing these triggers come to mind. You can put them on your desktop. You can put them on sticky notes that you stick actually onto your monitors in and of itself. You can have alarms that pop up on your phone or your computer every 30 to 60 minutes that just have the label and, that say the things that you need to be said, that need to remind you of. It's whatever works for you. So I would encourage you to experiment with the process. So yeah, if you think trying them on the second screen could be beneficial, give it a go for a week or 2, see if it works. Otherwise, we can experiment and try different things. Okay. I think that wraps up at least all of the questions that we've had through so far. The session, of course, has been recorded, will be uploaded over the next probably few hours. Like I said, at the very latest by the end of the day. Sometimes Zoom takes a little bit of time to process these sessions. So I'll get it uploaded as soon as it's ready for you guys. But yeah, definitely by the end of the day. Otherwise, if there's any more questions, if you're watching this maybe on the recording and you have a question off the back of today, please utilize the Discord. Like I said, I'm keeping tabs on it pretty much every single day. So I will get back to you guys very, very soon. Otherwise, enjoy the rest of your weekends. Thank you all for your time today, and I hope it was insightful. Speak to you guys again next week. I'll keep you updated about the timings. Enjoy the rest of your weekend, guys. Take care.